Yeah, so that was a great conversation. Thank you for having me. That was a great conversation for me to follow, because sometimes when you start talking about big changes happening in industry, and there's no doubt we've got some big ones, you start to wonder what it might have looked like 5, 6, 7 years ago at the taxi drivers or limo service conference, and how there were no doubt people who just scoffed at it. And I think the idea that if your best answer to iBuyers coming to town and gobbling up massive share of the business that you're in, and your best hope is they won't come to your market or they will limit their appetites, that's probably not the right response. All right, so a lot of changes happening here. All right, Renters Warehouse, big national property management company, buys Own America, one of the first and leading marketplace platforms, but it means a lot of changes, and I voluntarily made those changes to make sure that I was responding to the realities of the market. For one thing, I was CEO of 2 businesses over the last 20 years, and now I'm not. So now, I'm a 50-year-old guy with a 35-year-old CEO that I report to. So big changes, right? My wife, gotta love her, she said, well, what are you gonna do when someone tells you no? And I said, well, thanks to you, honey. I've been hearing that for years from you, and I've actually gotten really used to it. And she goes, okay, I get it. So you're going to stomp around, slam doors, and pout. I said, well, I guess, yeah. So anyway, long story short is that we're trying to build a national real estate brand around investors. That's all. So building a real estate brokerage company on top of a property management company allows us to deal with the financial instrument and the physical reality of property and merge them together and do something that, I dare say that you guys have not gotten a lot of value out of realtors over the years. A couple of exceptions out there, people that have concentrated on this. But you haven't gotten a lot of value besides people who maybe access something and open a lockbox and then get out of the way. We're going to have an army of people that actually know something about it. Maybe they'll be useful to you. Maybe they won't, but they will definitely be useful to the retail investor, somebody who is going to buy property from you potentially. So what I want to talk about today, I'm going to go fast because I want to try to catch up on some of the time, is what I see as a big opportunity for the people that have the skill set in this room that may be different than what you're doing now, and just present it as a possibility. Because I do think that these big players coming in with endless capital are going to do damage. And just like I last summer made a decision to make a change that meant a lot of changes to me personally, majority owner to minority owner, like a lot of things shifted in my world, but I did it all to make sure that I was able to stay on offense and I didn't get put into a defensive position. So I see the market with some interesting twists, and maybe this will illuminate something for you. $6 trillion is the amount of residential real estate that exists in this country. So that's apartments, that's single-family rental homes. That's the amount of residential rental property that exists in America. So 6 trillion. We hear trillions thrown around. Is that a big number? Of course it is. But what's interesting about it is that 6 trillion, if you look at the first 2 columns, single-family rental is the first column, and multifamily rental is the second column. And they're both 3 trillion plus. Now, what I remember the day that I sat at the IMN conference and saw Wally Charnoff put a chart up there that showed that there were already 16 million existing rental properties. I was hip deep in this industry for years at that point, but I hadn't yet seen how big that was. And I think a lot of eyes popped when they said, holy shit, this is not a niche, right? This is a massive market segment. And what's interesting is that red line represents how much of multifamily is institution owned right now. Okay, so 55% of multifamily, and we're talking, 10 units and above, 55% is institution owned. All right, and there was a time not long ago where that wasn't the case. And so I want to just track a little history with you and see if any of this sounds familiar. This is a chart that shows the market cap of REITs starting back in '85 and then really popping in the early '90s. Now, this is all REITs. I couldn't find anything that was isolated to just multifamily, but it kind of tracks the same way. What happened in the 1980s was do-gooders in government decided to deregulate banks. Banks went a little amok with lending practices, took some risks they weren't used to, and then the stock market crashed in the late 80s, and then we had, I'm oversimplifying, but follow me on this. We had a big distressed real estate situation that happened in commercial real estate as the decade turned into the early 90s, right? So the government creates the RTC, and there's this big distressed real estate dinner bell that attracts a lot of capital out of Wall Street because there was clearly a big opportunity as hundreds and hundreds of savings and loans went bad. Government took back all this distressed real estate, and then Wall Street capital came in, and they came in for a trade. They came in to buy half-built apartment complexes and then finish them and sell them. They came in to buy distressed office buildings and sell them. But once they got there and they got their arms around the operations, they realized, A, it wasn't as hard as they might have thought in the beginning, and B, they liked it. And so they decided to stay. And then the modern era of REITs, which is is it the middle button?
Green arrow.
The green arrow. Modern era of REITs kicked off here. Some legislation on taxes made it possible. But the bottom line was that distressed real estate, dinner bell, capital comes in for a trade, capital stays for a business, and then 20 years later, 25 years later, half of all the multifamily in America is owned by institutions. All right? Some of that probably sounds familiar because we had some deregulation and some government intervention in housing back in the early 2000s. We had some risky lending practices that were going on there. We had a big distressed property trend we all know about. We had Wall Street showing up for the trade. I remember the debate back in 2012 and 13, right? Is it a trade or is it a business? And a lot of people said it was a trade. They were going to come in, they were going to get out. And then they stayed. They got their arms around operations, and now it's kind of a permanent asset class. And what exists today, where half of all the multifamily is institution-owned, only roughly, Eddie's stat put it at 2%, but that was folks that own more than 100 properties. Institution capital probably owns 1%, 1.5%. And so the question is it going to follow suit? All right? And is it going to go to a third? Is it going to go to half? Single-family rental. I think it might. Okay? It might go to $1 trillion worth. That's what I think is happening right now, is that we're going to see over the next decade or two $1 trillion of consolidation, not by the 5 companies that are in the space right now, but by 15 or 20 more. Because we're hearing from new players that are showing up, players that are in multifamily right now, that have pension fund money, that have university endowments, sovereign wealth funds, insurance company capital, really low yields requirements, patient capital that values capital preservation, and a little bit of a yield is good enough for them. And people are showing up at our doorstep saying, hey, we're thinking about putting $1 billion, well, we're going to put $100 million in and test the waters, and if we like it, we're going to go to $1 billion and see where it goes from there. And guess what? They're the same people that took part in this. That's why I think it's going to happen. Not because it's just history repeating itself and the circumstances are so similar, but because it's the same people. All right? The folks that, well, you might have noticed, if any of you guys guys and gals, go to IMN, you might have noticed last May, all of a sudden there were 5 or 6 multifamily lenders that showed up at IMN as sponsors. Anybody pick up on that? Right? So you had Berkadia and Walker and Dunlop and Arbor, right. You had CBRE, I think. So anyway, all these people showed up on the leaderboard, not just showing up and sniffing around. They were actually spending the money to be sponsors. I, of course, became the welcoming committee and said, hey, let's sit down, let me talk to you, let me introduce you to people at SFR. I wanted to, because what I see is that when lenders show up, it's because, number one, these are all Freddie Mac lenders. Many of them were companies that went public because they were granted the right to sell Freddie Mac's multifamily product. All right, and it made them. And I kind of get the feeling that Freddie Mac might have said, hey, we're doing this single family thing, which they pulled back on, but I think they're still coming back to it. I think a phone call got made saying, hey, this is Freddie Mac. We would like you to maybe get involved in single family. And so they were all like, yes, sir. And there they were, sponsoring, right? Same people. And when I talked to them, my question to them was all the same. So are you here to meet people that own and are building rental portfolios in SFR and you want to give them loans? And they said, yes, of course. I said, are you here because you are scouting the market for your other clients? They said, yeah, that's really why we're here.
Well, Arbor, when they to pitch the Freddie Mac program, the Freddie Mac program got canceled, but Arbor stayed. So
Arbor's staying, yeah. Arbor
stayed with a single family bridge loan.
They're building their own product, and I think those people universally believe that Freddie Mac pulled out because they got their butts kicked, because they were supposed to go in, when Fannie Mae did their Blackstone deal, it was fat cats are getting government money. This is not right. Then Freddie Mac said, we're not going to go to the fat cats, and then they went to the fat cats anyway. Okay, so when Alan True is getting a loan, that drew too much attention. Billionaires getting low-cost financing. But if you read what Freddie Mac and the regulators wrote, they said that the people that got these Freddie loans, they didn't really need that kind of liquidity. There were other options in the market. Freddie's come back around since saying there is a need in the market for people at our level and smaller and maybe bigger, but the point is they are not giving up so soon, and I think the point's going to be made, and I hope that it's going to come up when Eddie and the team go to DC, is the idea that if you give low-cost financing to small and mid-sized landlords, that does derive low-cost rents for tenants. People are setting their rents based upon a number of things, and the smaller the landlord, the less it's about what House Canary says you should increase your rent to, and more about what profit am I making. If my cost goes down, then I can leave my rents where they are. It all winds up trickling down. So, yeah.
So on the multifamily, when these people got in at the beginning and they were buying on the SFR side, are they looking, if they want to grow, will they be looking for players to buy portfolios? Because the one-offs, according to your chart, the 16 million people that have that, they're not going to be able to scale fast enough. How would they do that?
Well, so this is, thank you for bringing that up, because that's my next slide, okay? I think we've got a food chain taking shape right now, okay? I love this graphic because in this graphic, forget about the sharp teeth, because getting eaten is the objective in the food chain here, okay? I think this presents an opportunity for the people in this room. That what's happening in the space is that we have now, for the first time, a biggest fish on the end of the food chain. And when that fish opens the jaws, it creates a pull, a current, all right? And the person that owns 1 might wind up selling to the person that owns 5 who's trying to get to 25, to sell to the guy or gal who's trying to build to 200, to sell to the person who's trying to build to 2,000, to feed it up the chain to the beast at the end. That's what I think the opportunity is there's velocity of capital in that current, and I can give you examples. And it happened in public storage, self-storage. It happened in funeral homes, right? I had a whole debate with a whole conversation at one of these things with somebody who was in that business, where it used to be mom and pop funeral homes, and then all of a sudden it became clear that there was some big fish on the end of the food chain, and then people in the funeral home business knew they could consolidate other funeral homes in their region, and they had some place to bring that. Okay, same thing with real estate brokerage companies. Okay, that was the game that I played in, where all of a sudden there was capital to buy other real estate brokerage companies because now there was Realogy. And then Berkshire Hathaway, that you knew you could build, a $50 million, $100 million a year revenue real estate brokerage company and serve it up for a 6 or 7 multiple to players that didn't used to be there. Was somebody raising their hand?
Yeah, was it ever mom and pop multifamily?
It was family multifamily. So mom and pop were making some good cash to be able to buy a 100-unit apartment building, but it was still private, non-institutional capital, going to the local bank. So it was relatable to the fact that it wasn't pension fund money and insurance company money that was backing multifamily back in the 80s and 70s. It was private.
So when is the rough ballpark of when that started getting consolidated, or when that shift started?
That was that chart I just showed you. That was the early 90s. Early 90s, and then it never looked back, right? So
You were born. That's what I said.
What's that?
I was born in 2003. So.
Oh yeah. So my kids say, you were alive back in the 1800s, right? Like, no, it was the 1980s. But okay. He actually said that, my son, 1800s. It's like there's an 8. Anyway, so this $1 trillion consolidation that feels like it's underway right now creates a lot of opportunity. And so what I want to present to you guys is this idea that the business of finding a distressed property and buying it for below market and then turning it, that might be getting tougher. Okay, it's obviously getting tougher because the market recovered, but it could be getting even tougher because when your postcard shows up in the mailbox saying we buy houses, and there's also an ad staring him in the face on Instagram or television or a billboard saying we buy houses, and that's from Open Door, they may go over there and get a quicker transaction or just as quick. But the point is there's a lot of competition for those eyeballs right now. And the more transparent the market is, everyone knows what their house is worth now. And so, they could hire an agent to list their property, but they don't want to for a variety of reasons. They're embarrassed about the condition. They know they're going to be told to fix it up. Whatever that is, those new companies coming in that have smaller margin requirements are going to make it tougher even more. So here's the concept, and it's the slow flip. This is not my idea. This is something that some people that we're doing business with, we were doing business with at Own America. We are now at Renters Warehouse. are kind of pioneering this concept, and it goes like this. Basically, you buy, you rehab, you rent, you hold on to it for some period of time, and then you resell it, and then you repeat, okay? And the idea of the hold, the strategy here is not trying to find a property that you're going to be able to get under market, but looking for markets that are in the process of getting lifted up by things like population growth, job growth, changes in demographics, whatever. That's always been where that is what Own America's technology and our Vendors Warehouse's technology is all about, is trying to find the markets that are about to pop based upon those shifting plates of earth. Because if you can put 24 months worth of time between when you buy and when you sell, you can yield along the way and maybe get 5, 6, 7% appreciation and then resell it. And that's the food chain. If you can resell it with a tenant in place, buying a property, renting it out, and then kicking them out after 2 years, and then dealing with cleaning it up for the retail market and paying a full commission, that's not the thing. The thing is, if there's a robust market to sell occupied rentals into that food chain, well, then you can do that slow flip. Does that make sense? All right, so let me just share. This is a chart that we've seen a couple times in the last couple of days. Mine starts in 68. And this is National Association of Realtors data. Very funny, when I first got this, it was right around here. And when I started the company, and I went to NAR, and I was a member, so I said, hey, the research department, do you guys have long-term housing data? And they said, yeah. I said, can I get just the median price nationwide for as long as you go back? And they got back to me 3 weeks later and gave me the data that made this chart. And I asked how much it was going to cost. They said, no, it's free for members. I said, I forget how I asked them, but the nature of the question was, why did it take 3 weeks? Not that I'm complaining, but I had a feeling I knew the answer. And the answer was, you're the first person that ever asked for it. Okay? So the chief economist at NAR was out there going, there's no problem here, but he had not yet seen what at this point was this chart right here. All right? So of course, bad, probably, I think this is bad, I think this was good. All right, this was a correction, and I love the fact that the recovery, I think we're a little high right now in terms of the prices, but what I love about this line is that it shows you Democrats, Republicans, wartime, peacetime, high rates, low rates, dogs and cats, it's all on the same chart. And all these people who say, what goes up must come down, didn't ever see this chart. I know people in real estate who said the crash of the 80s. The crash of the 80s, of 81, was a crash for people who sell real estate for a living. Nobody was buying real estate when the rates were 18%, but the stats don't lie, the market just leveled off. All right? The crash of the early 90s was, again, not a crash, but people in the real estate brokerage business who get the microphone talk about how there was this massive crash, but it's impossible to convince them that the crash was in your business because home sales plummeted, but home prices only leveled off, which is why I think we're going to see a leveling off, because I think we're a little high, but there's no reason to think it's going to do this because it's never done this until this happened, and this was inflated because of lending practices that were too lax. So, but this is national. I want to go granular. This is a chart. By the way, every one of you people, I was going to say guys, but I know there's a couple of ladies. So every one of you, I'm a New Yorker, so guys is gender neutral. Every one of you guys can open a free account on the Vendors Warehouse website and load your properties up into a private account behind your password and see a whole bunch of mapping calculators, photos, interactive projections, and this chart, which is my favorite, which is the 20-year unadjusted for inflation, unadjusted for seasonality, straight up median sale price going back to 1998. All right, the reason I love it is the blue line is the US, the black line is the state, the green line is the county where the properties are in. And what I love about it, this is the end of that chart I just showed you where it was the housing boom, the housing bust, correction, then the recovery, and like it fought its way back. It seems like no matter, if you create a trend line from the beginning of this chart and you split the peak and the trough and you carry it forward, that's, I think, where it's going. And I've been told by economists that's way too simplistic, except for the fact that I was making these predictions 10 years ago. I wrote a book about it. I went on the Fox Business Network a bunch of times, talked about it, and I did a radio show about it, and some of the markets that I picked based upon this analysis are the very ones that popped. And the analysis was, how did the market perform prior to, what does it look like during the correction, and what are the population trends, the migration patterns, the quality of life, cost of living fundamentals that are causing people to go there, If they go there, are those trends likely to continue? And if they are, does that mean extra lift for that market? Where if you did something like I described a couple of slides ago, the slow flip, can you take advantage of something that because of your research, you see something that's popping, and then get your returns based upon yield and then outsized appreciation? So this is Atlanta, all right? And what does this tell you? It started off, it kind of rode the party on the way up. It had a really brutal hangover. This hangover had a lot more to do with the overdevelopment. You saw those 60,000 housing starts that we saw on the chart yesterday. All right, then the market fought its way back. And I know there are people who are saying, well, Atlanta, they look at this and they say Atlanta can't sustain this. But this is just catching up, right? Again, you take this line and where does it end up? I think Atlanta's going to level off a little bit purely because of this analysis, right? I'm going to show you a bunch more. I'm going to fly through it quick. So here's Tampa. All right, so again, the green line is Pinellas County. The black line is state of Florida. So you see big party, big hangover, again fighting its way back. But again, I keep hearing people talk about how the Florida market is a bubble again because all they're looking at is the short term, and it reminds them of this, but they forgot about this, and they're not looking at that same analysis. I think we're right there, so I think it's going to level off. Phoenix, a lot like Florida. Big party, big hangover, but again, fought its way back. I find this so gratifying to see market by market tends to, the peak and the trough are different, okay? The similarities of Florida and Arizona and Vegas are unmistakable, right? New York going to Florida, California going to Phoenix, hot investor markets during the boom times, big foreclosure markets during the bad times. But see, I see this kind of market kind of like if you had two forces of nature doing battle, one was a glacier, one was a forest fire. You might think the forest fire is stronger, but the glacier is going to win that battle every time if you give it time, right? The glacier is migration out of California because they spend all the money and then some, all right? So people just eventually say, the hell with this, I'm going to go someplace else. They feel comfortable in Phoenix. And so it pops, it troughs, and then I feel really good about this trajectory right here because it's mild and it's right along the same lines. Here's Kansas City. See, the story here that I love is that no party, no hangover. Little hangover. Nothing crazy, all right? The average appreciation, I haven't been highlighting that, but the average appreciation for the country is 3.4 and change. The average for the state of Missouri is 2.2. And the question is, in Kansas City, when I take a look at this, again, it's right there, and I think you can count on this is my point. All right, now if something was happening in Kansas City that caused me to think there was going to be massive job growth, I'd be thinking that's a place that's going to pop with maybe 4 or 5%. I don't see that right now. I don't know, although what I've learned about people in Kansas City is they're sure that Kansas City is the center of the universe. They just don't think we've all figured it out yet. Yeah. But I like this because this says they're not fooled by trends, right? The trends, people say things start in California and go across the country. Not always, right? In this case, it was like bedrock. Here's Baltimore. I just wrote a piece. Fred's going to kill me because, not Fred, Jack's going to kill me because he was just telling me that Baltimore is great because Wall Street doesn't know how good it is. But I wrote a piece for Think Realty for next month that says, Wall Street's missing one of the best investment markets. He's like,
Baltimore sucks.
What's that?
Really?
Baltimore's terrible, yeah.
There's a lot of crime. You come there out good.
Every police car is upside down and on fire in Baltimore.
We got a cartel going here.
Yeah. But here's what well, every one of these cities has a story, is the beauty of it. And like the thing about Baltimore is that it did party, it did have a hangover, but not as deep as other places. And it looks good to me. And I do, again, that analysis tells me there's some serious upside there. And it is a very well-kept secret. And the thing about Baltimore that I think is great is that Baltimore is part of the DC solar system. It's not its own little city out in the middle of nowhere. It's part of this whole mid-Atlantic DC ecosystem that, I mean, New Yorkers think they're the center of the universe, but actually I think DC probably is, all right, the seat of power in the whole world. So this is a chart that you would think is in a market that is doing great, but it's considered to be a distressed market, and yet here's the appreciation chart, which is among the best in the country, almost 5% annual appreciation over the last 20 years. Here's Detroit, all right, so the green line shows No party, big hangover. We know what the hangover was about, right? The erosion of the job base there. But hasn't that been remedied now? There's some long-term trending that are, auto industry is being muscled to come back. And so I love it. I think, this is a place where you can get this negative appreciation over the last 20 years isn't going to last. And this is the kind of place where I think if you bought, held for 24 months and then resold, you have a chance to see that kind of thing pop. And I guess you guys know that already. Jacksonville, Florida. Right? Again, it's all the same thing, right? It starts off, it peaks, it troughs, and it comes fighting back. When the market's left alone, the market performs well. Denver. So now I'm going to give you a twist, all right? So these are now markets that have already popped, that are probably going to continue to grow, but maybe this kind of a steep end to the curve would make somebody nervous that they were going to apply the strategy of I want to buy in places they're going to have outsized appreciation because maybe I missed it, right? So we're being asked by professional investors who are new into the space, where should we go? My favorite question. Where should we go where Invitation Homes isn't? All right, where American Homes for Rent isn't? Where are the next places that are going to be the hot markets? We don't want to be David amongst all these Goliaths. So Atlanta's awesome, but we don't want to go to Atlanta. What is like Atlanta? Well, Denver, I'm really proud of the fact that I went on TV talking about Denver being an awesome market right here. All right, so I doubt anybody saw it because it was the Fox Business Network and they have an audience of like 4 people, but it's on record, right? That market took off, and it took off because of fundamentals, market fundamentals, quality of life. I mean, it's not complicated stuff here. It's why do people go to a place? Why do they love it? And what's that?
Smoke some weed.
Smoke some weed? Well, it's a fun twist that an industry that's going to be a beast of an industry decided to set up shop there because the government, while all these other governments were wringing their hands, I don't care what you think about the politics of cannabis. As an investment thesis, that's an industry that's a monster that is going to be setting up shop in that state. Because while other governments were saying no way, some states were saying maybe, Colorado was saying come on in. And so people are planting their flag, and that is as big as an energy industry boom. It's as big as New York's got the financial district, right? California's got entertainment. Texas has oil and everything else. And then you've got Denver that now has weed. All right. A lot of what? A lot of pizza in Denver? I didn't know that. You know what was actually the big hook for me? When I was in Denver back in 2012. I'd say I missed it. That's good. So the question is, what is like Denver but is not yet Denver? And Colorado Springs might be. So here's Colorado Springs. It's an hour north. Didn't have a party, didn't have a hangover, and is now starting to show signs of getting that pop right there. So I love Colorado Springs. This thesis lends itself well to that. Same thing, Nashville, same kind of chart. Look at the green line. What's that? Yeah, no, you made a lot of money in there because you bought right around here, didn't you?
Well, look at the cities where the mom and pops have the rental properties, right? The single families, 1 and 2 concentration. And instead of creating new stock and buying a new stock,
buying existing stock, yeah. Well, that's what
existing stock, all right? And, if it's concentrated in those cities, even better.
Well, we're launching in 3 weeks the first pilot program for our version of iBuyer for SFR. We're doing exactly that. We're going to be advertising in their face on Facebook saying, we buy single-family rentals with tenants in place. I'm not sure how we're going to word it yet. The marketers. So I work in a company now that has a marketing department. It's great. I don't have to do everything anymore. So they're going to come out with the messaging, but the idea is targeting people saying, we buy SFR. You go to the page, you put your rent in, you rate your condition, and you either get an offer or we get a listing lead, as a result of that. So we're doing that, and we're trying to create a situation where institutional buyers, professional buyers can dial in their buy box. You can do that today, exactly where and exactly what you want and what your gross yield minimum is, and really dial it in tight because it can pop an offer in front of these people. They can accept it, and then you go to contract. Okay, I think iBuyer for occupied SFR is far superior to iBuyer for vacant properties because if you can't sell it right away, you're making money along the way. All right, so I think it's going to work real well.
Where are you going to do that?
We're starting in Memphis and Dallas, probably first, maybe Charlotte. And it's only because those are the places where the clients of ours that are like hot to try this, that's where they want to buy.
Okay.
So we're just backing it up with people that we want to prove the concept, and then it'll be everywhere.
Greg, what's the disposition of what you may buy? Is it to your clients? So you can give your clients a pipeline of inventory?
Yeah, or a pipeline.
Where's Renter's Warehouse going to become a buyer?
I don't think we're going to become a buyer. I think we're going the route of the way Zillow did iBuyer, which is put buyers behind the curtain and then advertise and market. And if we don't have an offer for you, then we have an opportunity for you to list with us. So keep in mind, Renter's Warehouse is now a real estate company. So if somebody says, I want to get an offer in Kansas City, we don't have a buyer in Kansas City for that, then the next thing is, hey, would you like to, turns out you want to sell your property, do you want to list it with us? And then it's going to be listing it. We're looking to put these things in the MLS. Occupied, you can't show the property. We're looking to leverage whatever marketing channels we can to get attract the eyeballs to it. But it's just proving, they have proven that there are enough people that'll say, I'll sell my house. I mean, home investors proved it. You guys all proved it years and years ago. People want an easy experience to sell. But people that own occupied rentals, and you probably know this, you call 100 realtors to say, I've got 10 properties I want to sell. They're like, oh, goody. And then you say they have tenants in place. They say, oh, shit, you got to get rid of those tenants first. Now imagine that with an apartment building or an office building. You want to sell your office building? Great, get all your tenants out, vacate it, start losing money, and I can sell your building for you. That would be absurd, but it happens every day in residential real estate. So we're trying to create a dynamic market of occupied properties where the seller wins because the seller cash flows to the closing, no friction cost. The buyer wins because they cash flow from the closing, and nobody's kicking tenants out. They get to stay in the house, so they win also. All right, so Nashville. What is the next Nashville? I think it's Chattanooga. What do you think of that?
Chattanooga's good.
Yeah, Chattanooga's hot, right?
VW's plan.
Yeah.
We go anywhere there's an automobile manufacturer.
Yeah, so like Huntsville, the Super Bowl had the ad for West Point, Georgia, right? West Point, Georgia, where Hyundai is doing. Is it Hyundai or it was Kia? It was Kia. Anyway, so you see the point there? If you like Nashville, you like Tennessee. If you like Tennessee, you probably like Chattanooga. Chattanooga's got a gazillion miles of fiber under the roads. It's got the microbrew foodie thing. It's got the hipster thing. VaynerMedia has an office there. There's a lot of things that recommend that market. And I think you're going to see something where this is the beginning of a little bit of a ramp. And I think it's got plenty of room to go because, again, when you see no party, no hangover, that gives me comfort that it's not blowing around like the wind. It's a very steady bedrock market that now is going to have liftoff because of the trending demographics. Yeah.
States with no state income tax, I think, are huge. Tennessee, Florida, Texas. You look at where the big boys own a lot of assets, many times it's where you don't have
No state income tax.
one of the reasons why corporations move to those.
Yep, it's a big element of cost of living. So when you've got cost of living, climate, quality of life, inbound jobs, and people who are there stay, and people, are moving there because where they are sucks. Now look at Houston. I remember a couple of years ago in Houston, there was an article in the Houston Chronicle where it had people being interviewed in a diner talking about how the market was going to crash because oil prices were down. Right? I thought gas prices being down was good for the economy. Okay, no. Now the market was going to crash. We said that's nonsense. The oil industry is a big driver of Houston, but it's not the only thing that Houston has. Houston's still in Texas, and it has all those drivers. And then it was going to crash again because of a hurricane. All right, well, look at this. So the market's doing great. You might feel like you might have missed it. It might be a little bit high on this chart. So what is like qualitatively? What's like Houston? All right, maybe Pittsburgh. Shale fracking. Energy industry, right? I don't know. They seem relatable to me. And again, Pittsburgh didn't see anything. It's just steady as she goes, except for this right here, which is all explainable by the job base that eroded is coming back and upward pressure because of the energy industry. Right across the border in New York, the government won't do shale fracking. Pennsylvania's friendly to it. So I think what happened in Houston because of energy can happen there. And then Dallas, same thing. Ski jump right there. I don't think there's any reason to think it's going to slow down that much here. I think it's going to maybe level off a bit. 6.38% a year for 20 years is a pretty steep thing. It should probably be more like 4. But all the demand drivers are still pretty robust, and so there's no reason to think that it's going to go down. But if you wanted to catch a place that's like Dallas, but just 20 years earlier, how about Oklahoma City? Right? So you see the idea here? Show me the next Atlanta, show me the next Tampa, show me the next Dallas, and it's just about qualitative things. And here, again, didn't get fooled by the trend, but the energy industry is really strong down there, and electric cars are great, but they're not necessarily taking over the oil industry yet. Last thing, and then I'll go real quick. I just wanted to make one point that these people are ridiculous. Experts predict next recession. Nearly half of the experts predicted that. That means more than half said the opposite. But that's the headline. Right? I mean, and by the way, this was Inman News. Economic crisis was the image they put above the story in their thing. So I don't know what Brad Inman's motivation is. We can speculate. But I know that they gamed this survey. And it says so right in the subheading. But people didn't get past this or this. All right? Now, I don't know what Zillow's trying. Maybe Zillow's trying to create a lot of listings. I don't know. Who knows? Here's another one I liked. The Business Insider. Remember yesterday there was an article. You know, people are saying the market's turning, but they're not saying it's crashing. Well, what is that image there for then? Right? The building collapsing. U.S. housing market took a dark turn, fell off a cliff. Mortgage lenders saw a steep decline. Buying homes stopped. It's bullshit. All right? But it's going to cause people to do stupid things if they don't know any better. And here's my all-time favorite. This was just a capture from an email that I get from the Street Report, which I don't know what that is, but they got my address. Their top headline was, Fed could double rates. I clicked on it. You know what it said? The article said, Fed could raise rates 2 times. So, and that's that. All right? So, and that's what I have. Any questions?
Yeah, I have one question on the trillion-dollar consolidation concept. The thought is, a lot of people who own real estate don't mind owning real estate. A lot of the 10, 20 unit guys like owning the real estate, and they're only going to sell if someone's going to buy at a cap rate that they find not to be interesting any longer. So I guess where I go is, are we looking at the big shark being a 5-6% cap rate buyer? And then if so, one of the problems with single family is that it's filled with liars, and people, and all the numbers are so varied. There's no consistent standards. When people produce their numbers, it's very different than when someone else produces their numbers. So it's not like multifamily where you can get to the analysis pretty fast and you get to a stock style cap rate. In single family, we're not at a stock style cap rate. So I don't know. I just question whether we're going to have a $1 trillion consolidation. Maybe we'll have some consolidation.
Yeah, well, my answer to that is that the big fish right now all look exactly alike. Right? We've all been at the IMN conference where all the biggest brains in the industry said, after careful consideration and a whole bunch of PhDs, we decided on Atlanta, Tampa, Nashville, Dallas, Houston, and we're buying houses built since 1980, 3-bedroom, 2-bath, and a 4 or 5 school district. How about you? Same thing as what he's doing, right? They're all doing the same stuff.
But at the same time, the institutional home guys quietly say, hey, if we could get rid of our street class, we would. But they're all in funds, and they're all under certain names, so we can't quite do that yet. So they quietly try to oversell to guys like us, and guys like us say no. So I think their focus is just the A markets. So you're saying that
we're going to see diversity of strategy.
Is the A market conversation?
We're going to see diversity of strategy. We're going to see overseas capital. I mean, what are the Chinese investors buying? Luxury condos in Miami and New York and leaving them vacant. They don't have a big hard yield requirement because they're going negative on yield. We're seeing we're activating the retail investor who's taking money out of a 0.5% savings account or CD, and to them a 3.5% yield is fine when it also includes appreciation because they're thinking about this as a 30-year retirement program. We're trying to activate more and more people with different kinds of strategies, college towns, senior housing, all the things that multifamily did to diversify strategy away from the vanilla is I think what's going to happen here over the next decade. Eddie.
I think the point though that you're making, is we may be 10 fish out that way, right? And the consolidation is a period of time that's going to happen that will standardize some of those practices, right? Like, I don't think the big fish right now is trying to buy, like big fish. Like if you look at the previous history of the multifamily industry, it took multiple periods of consolidation to get to the point where the really big fish entered into the market, pension fund, all the really big money. And today, what we're seeing might still be 3 fish deep. We might still be 10 fish that way. You know what I'm saying? Like, I think that there's still periods of consolidation that will standardize to ever get to that type of volume.
And I'll give you a great example just real quick. We just pitched last week the Cleveland-Austin combo platter, right? Like Cleveland is a high yield, low appreciation. Austin is a relatively low yield, high appreciation. You blend them together, you get a 6. They want a 6. Like, where can we get a 6? You can get a 6 by splitting your fund between Cleveland and Austin, play 2 different trends, end up in the same place. So diversification. I see just like every part of this country has a story. All right. I look at multifamily and I see that there was a lot of very vanilla strategy, and then you see everything from luxury to communities that are mixed use, to garden apartments, to 55 and older, to assisted living, to student housing. You see a lot of diversity. The geography, there's a lot of people that don't buy into this idea of buying someplace away from where they live. Right? Our competitor Roofstock is all about, if you're in Silicon Valley, which is where their buyers are, you should buy someplace else. We're saying, like, we just put an ad out. You don't own enough Denver. You don't own enough Tampa. If you live in Tampa, operate your business or your career in Tampa, you know you live in an awesome place. You know you don't own enough real estate investing where you are. So why do they live in that town? They live in that town because they need to. They should buy more of it and accumulate more of it. So I think it's going to be, here's what I know. The more we reveal the truth about how single-family rentals perform, the more beautiful it is. Okay, realtors totally dropped the ball. Okay, they've been representing this as a home ownership, owner-occupied industry for the last 50 years. They don't even know they think a yield is a triangle sign that says that guy goes next. Okay? They have no idea what the word means. The industry blew it because it's better than commercial real estate. It's better than multifamily. It's better than retail and office because it's inextricably tied to population growth. Right? That's just it. People come here, they want to live here, they want to stay here, they want to live indoors. It's real simple. They want to have kids, they want a backyard. So the market fundamentals are so solid. You guys all know this, but nobody's ever put a sort of a microscope on it until Wall Street came along and made us all do that. Now our technology is offering those same analytics to the public. I mean, check it out, because it's like video game style interface. It's like designed to be fun and interesting, but what you see is I can get a 4% yield in Denver and a 5% and 5.5% appreciation if the last 20-year average holds. That means I'm at 9.5, and I can buy houses 10 miles from where I live, which I know this place is kick-ass. That calculation is going to be made by lots and lots of people over the next bunch of years. It's not a cost of capital plus my margin plus. It's I got money in the stock market. Those guys, the president farts the wrong direction. The market goes down 500 points. I'm not up for that anymore. Let me get something that. I'm not investing in housing because nobody's helping me do it. I went to that seminar where the guru sold me a get-rich-quick scheme. There's no real estate company to help me, and who's going to manage the property? So we aim to solve all those problems by walking to the office, go on the website, learn how to do this right, modest expectations, 25-year hold period.
Isn't that the Roofstock model? Isn't that what they're doing with average investors?
Yeah.
So it's the exact same thing?
No. Boots on the ground, real estate offices, boots on the ground. Yeah, well, they're an online store for rental properties, and it's awesome, okay? We are a real estate company where you actually sit down with somebody and...
So you're truly, if you really look at it, you can truly morph it into a turnkey provider.
We're not just selling occupied properties, though. We're selling MLS properties also. We're Charles Schwab beats RE/MAX.
Their model, I mean, just because I have some experience with Roofstock, sold through them. Your model, albeit dangerous for a guy with a property management company, is much better because they have some real, ground game. They have some real knowledge in the markets that they're selling in. Roofstock relies on property managers in every single market that they don't really vet all that well. And they really don't understand the business the way. Rental warehouse understand.
It takes them more than 30 days just to post a property.
Like that? Yeah.
Listen, those guys are strong. Listen, I love them. They're the ones that established the category. When they bought 643 Capital, I called Kevin Ortner, right? Marketplace platform buys property management company. So they have led the way at establishing the category. And the vulnerability that we felt of being only online, I'm sure they're feeling also. So we decided to go and build our business on top of an existing infrastructure. I'll give you this last thing. When we started talking about this and I was talking to their board about this, it was as if somebody came to me and said, look, we have 41 restaurants around the country. They're popular restaurants. People love it. It's great. We want to double the size of our revenue base in this exact same footprint. How do we do it? And then I said, well, do you guys serve breakfast and lunch? And they said, no, we don't serve breakfast and lunch. I have an idea. They were a property management company, 41 branches, 200 licensed real estate agents, never sold a house. So all we're doing is layering a new service offering on top of the property management company that basically says, we're going to feed our machine of new property management doors by selling a whole shit ton of property to people and then hanging on to it and managing it for them. So it's a painfully simple model. You can't stop us. Nobody's going to be able to stop it, right? I can't stop Roofstock from succeeding, but nobody can stop us from succeeding because this is the infantry approach,
What you're not saying is linking financing into that whole pie. I'm sure you thought about it.
Yeah.
Because it's the one piece you're not saying.
Insurance is rolling in, financing will roll in. And I think we'll convert a lot of financing because, again, which are the traditional lenders out there? You go to Rocket Mortgage and say, I want to buy an investment property. They call you and say, when do you want to finance your home? It's like, it's not my home. It's an investment property. Nobody has taken the Fannie Freddie product, the straight up regular agency product, and actually trained and instituted any kind of program to sell that. So investors, man, what I love about you guys, the reason why I'm passionate about this is that it pisses me off that everybody who's doing this had to figure it out for themselves, had to do it the hard way. The reason these masterminds work so well is where else are you going to go to learn except for each other? Now think of the individual, high net worth individual that wants to invest in real estate but isn't because he doesn't know how, she doesn't know how, nobody's there to help him. We're just solving that problem. All right? Thank you.
2 minutes and then Nathan's going to present. Thanks.
Thank you.